right, welcome to the July Economic Update. I'm John Cleaver, partner, senior financial advisor at Beyond Wealth Advisors. And back with me is Grant Gehring, director of product research and portfolio strategist. And we are here for a mid-year update. Believe it or not, we just celebrated 4th of July, and we are halfway through the year. I'm not sure where 2024 has gone, but here we go, right?
That's right. It's
Fantastic. Gone. So our topic for today is it time to celebrate? So let's get into it. Heading into 2024, we expected 5 or 6 rate cuts potentially, maybe even the signs of a mild recession. Certainly inflation rates coming down to that 2.5, maybe even that 2% Fed target. We're halfway through the year, and so far none of those predictions that the so-called experts were claiming have come to pass. So what's actually happened in the U.S. economy here to start the first 6 months of 2024?
Well, thus far, the GDP has been okay. Perhaps a bit soft, but positive nonetheless. We've had solid employment, wage gains have bolstered. The U.S. consumer has been surprisingly resilient along the way, which has also translated into some solid corporate earnings. Inflation has cooled off a bit, but it still remains above the Fed's target. It's sticky. It is sticky.
Absolutely.
So consequently, no rate cuts have happened. We've seen something like 34 record highs for the S&P 500 this year, and that's really thanks to the unbelievable, the mega
technology stocks just continue to run strong.
Yeah, unbelievable. And then U.S. dollar also remains strong. So those are some of the good things.
So, I think if you would have said you're going to get all those things back in January, we would have said, hey, we'll take that. It sounds like really pretty good news. So back to the topic for our talk today, does that mean it's time to celebrate? Is this so-called soft landing and or transition through this slowdown in the economy actually going to happen, or as they say, is there more to the story?
Well, I'm an investor, so I'm kind of a bond guy. I always have a little bit of a glass is half empty kind of thing, half full, if you will. Anyway, there is some nuance to the story, I'd say. Corporate earnings are sound as of now. We're seeing very low default rates. Even after all these years, time with high interest rates. Some consumers are doing well, but others are really struggling. So that's kind of the, people in the higher income continue to thrive. People with middle class, lower income, they're really feeling pressure. I mean, the huge savings, that we had during the pandemic, that's gone. Now savings levels are below average, historic averages. So.
We really feel that too, even in talking with clients on a daily basis. They're kind of all over the board. Some are definitely feeling that pinch, maybe even those that are on a more fixed income perhaps, or maybe an income that doesn't increase with inflation quite as much as inflation increased.
Wages are up, but inflation's up a lot higher often.
Absolutely. So we're hearing that kind of anecdotally that, hey, things are still kind of tight out there, particularly in certain segments of the economy.
And we're even starting to see some missed payments and some defaults going on with credit cards and auto loans. And then, let's talk about a little bit about mortgage rates. They're still really high, and housing prices also high. So you've got people that aren't able to buy homes. So.
Would you have suspected maybe there would have been more movement in the mortgage rate area by now, just kind of all things considered?
Well, it kind of runs in tandem with the 10-year bond. But it's been a little higher than historically that spread between the 10
because it started to inch back just a little bit, and then it kind of reversed course, and here we are back where we're at.
Yields have just been stubbornly high.
Absolutely. Yeah, it's interesting how that increased inflation impacts so many different things that we don't maybe normally think about.
Insurance is one people see a lot. House insurance and car
insurance. I've heard that one a lot lately too. Absolutely. All right. Well, we always talk a lot about the difference between the markets and the economy. We've kind of touched on the economy here a little bit, and while things seem good, but we know that pendulum can swing quickly to the other side. So let's talk just a little bit about the markets. we mentioned already that tech stocks, those mega
Yeah.
tech stocks, continue to just have some amazing returns this year and kind of really impact the outcome.
Hmm.
The buzzword right now is AI.
Yep.
So
Sure is.
we're still in that AI boom, I assume.
Yeah, absolutely. I mean,
Yeah.
I don't even know if we know what the end of that looks like. I mean,
Absolutely.
it has some really far-reaching effects,
Mhm.
arguably across all sectors.
Sure.
But right now, technology has been a big winner. But
Mhm.
we'll see how that
Energy too.
energy, yeah,
Yeah.
for real. You've gotten double-digit returns actually in communication services, technology, energy, financials.
Right.
Year to date, so that those have been solid, and really, in fact, only real estate has been negative this year. So along with this, mega cap boom, we are starting to see maybe a little bit of
A little
broadening
bit
of the
of
market.
broadening. I know we've been talking about that through the better part
Right.
of this year, that because the Magnificent Seven was kind of the story of
Sure.
2023. I think a lot of people expected that broadening to happen. Maybe quite hasn't fully broadened yet.
Probably not. No,
Yeah.
there's definitely more
Yeah.
to come.
Yeah.
And then beyond, we can kind of look beyond the U.S. large cap story.
Sure.
We are starting to see emerging markets
Yeah.
take off a little bit.
Yeah.
They've been off to a pretty good start, which we thought. I mean, at the
Sure.
beginning of the year,
We actually expanded some exposure into EM.
we did.
Kind of early on.
Yeah.
Absolutely.
And then on the other hand, developed international
Oh,
small
gosh.
cap, U.S. small cap. They
no love
lag.
for the small caps right now.
Not at all. I mean,
Yeah.
we're at like the largest margin of difference between small
Yeah.
cap and large cap since like 1980.
So the positive way to think about that is there's a lot of value in the small caps. We just need that catalyst, right?
Right.
That once interest rates do start to pull down,
Yep.
potentially small caps tend to respond favorably.
Yep.
Maybe we would have expected that by now, and because of that, they've just kind of just been stuck in the mud.
Yeah. I mean, I think
Yeah.
the high interest rates have really
Mhm.
weighed on them more.
Yeah. All right. So that's looking back. Let's transition a little bit. Second half of the year. There's a lot yet to happen this
Mhm.
year.
Yep. Could be interesting.
Geopolitically, U.S. politically,
Yeah.
interest rates.
Right.
All right. So do you dare put some thoughts on where this thing's going to go?
Well, the Fed's indicated maybe 1-2
Sure.
cuts now.
Sure.
So, but we can expect these interest rates to stay
Yeah.
higher.
Yeah. It's tricky for them too, right? Even with the election, when and how do they cut? How much do they cut?
Yeah, and I mean, it's, as they say, it's data driven. So
Yeah.
they're looking at those inflation numbers, and they're paying
Mhm.
attention to that, the jobs and all that
Right.
closely. So, but with this inflation high, with these rates staying high, that still puts more pressure on the
Mhm.
consumer. So we have that risk of
Right.
weakening economic growth. And even though we haven't really seen what we thought, it's still, that potential exists,
Mhm.
and it could happen. Maybe it's just going to happen a little later.
Right.
That's a possibility. It's important to remember that the yield curve has
Right.
been inverted since July of 2022.
So dumb that down. What does that mean to the average person?
So the front end, which means you're borrowing on the short end of of a shorter term loan, actually
Right.
pays you more than the longer term loans, and
Yeah.
that is not the normal
Typically
slope.
how it looks.
Correct, and
Gotcha.
that's because we had this
Right.
historic raise of rates by the Federal
Right.
Reserve, and so you're sitting at that. So historically, when that curve normalizes, meaning the short end comes down and the long end goes kind of
Right.
back to the way it is, you see a recession a few months after that. That's
Gotcha.
that's just historically speaking.
But we're still inverted, so
Yeah,
maybe
right.
premature on any type of quote unquote
Right. And so
recession.
we won't see that probably until the Federal Reserve starts their cutting, and
Right.
we'll see when that happens.
We'll
So,
see when that happens for sure.
Yep.
All right, so we talked a little bit globally already, looking backwards. So what's more the outlook when we think about where things could land internationally?
Well, I mean, the U.S. really still stands
Yeah.
out as a leader.
Sure.
Versus pretty much all cap sizes of the U.S. I mean, I know the large
Right.
cap has really taken off, but as you mentioned, and we talked about, some mid caps, small caps have some really good valuations. They've got strong fundamentals.
Right.
And once the cuts come, that's a catalyst for small caps.
Now
So
we have seen some other countries lower their interest rates.
we have,
right?
yeah.
And so that's starting to have some impact. maybe more on the emerging markets, like you mentioned already.
Right. So emerging markets, they were the first really to raise rates, and now they're the first to start easing policy.
Yeah, sure.
And so that makes emerging market equities, emerging market debt favorable. Their fundamentals and the sentiment are getting better. So we're kind of starting to see recovery. It isn't just it's a country to country story, really, because there are winners and losers there. We talked about friendshoring in the past and some of those things, some of those terms, and certain countries are benefiting from them more than others. So
that's an interesting point, and maybe you can just reinforce this, but that's something that we tactically took into account back in January when we were reallocating, was really moving away from more of a universal approach to EM and being much more country specific. Correct?
Correct. And really, emerging markets, that's a broad category when you think about it. I mean, you have value stocks and growth stocks, just like you do here. You have multiple different countries and various levels of economic freedom within certain countries, and so that the government sometimes
much more laser focused in our approach, right? At least that's the approach we've taken so far. So, all right, well, fantastic. Well, I know you mentioned early on you're kind of a bond guy. You kind of like that. You've mentioned debt a couple times.
Yep.
So maybe your favorite thing to talk about, particularly right now, right? Maybe give us a little bit of an insight on fixed income, and where do we see fixed income or the bond side of the house going?
Well, that's a positive area right now. So if you need yield, it's still very high. Prices of bonds are still often below par. So you've got the income generation component, and then you have the possibility of capital appreciation too.
Right.
So considering we're still in that time where spreads are tight and we don't know exactly, companies are strong, but we still, higher credit quality makes sense right now, maybe more moderate duration. I know you want to kind of go out on the curve, maybe lock in some of those yields before they start to come down.
Sure.
Emerging market debt, I mentioned, that's a really interesting area. You got to be selective there. You need a manager who knows what they're doing.
Sure.
And then finally, we can talk about high yield bonds a little bit. They've actually performed very well.
Sure.
Like I said earlier, default rates are low.
Yeah, stayed really low.
So as spreads start to widen, and as long as default rates remain low, high yield could be an area that becomes more interesting. So again, selectivity.
Right. So being selective, you've mentioned quality. I know, again, just from a strategy standpoint, we really went after quality.
Yeah.
6, 9, probably even longer than that ago in the fixed income part of the strategy. And you see that continuing, right? That flight to quality on the fixed income side.
Yeah, for now. Now. I mean, and even within high yield, you always look for the highest
the
quality.
best of the best.
Right. And so quality is kind of the story we've been talking about broadly across the markets in fixed income.
Yeah.
And I think, with elevated interest rates, there's less room to wiggle a little. Your chances of possible failure could be, in those companies that aren't necessarily taking care of their balance sheets and whatnot. So
fantastic. Well, we started off asking the question, is it time to celebrate? So any parting comments on how you would answer that holistically?
Holistically, yeah. I mean, it's been, you can't deny it's been a good start to the year. That's helpful. We've got some momentum building.
Yeah.
I still, I say be careful. There's still potential for volatility. There always is. I mean, markets go up and markets go down, but keep a level head throughout the whole thing. That's just the best way. That's the best approach anyway.
Absolutely.
And diversify your portfolio. I think we say that all the time, and maybe people get tired of hearing it, but it's tried and true.
Well, thank you, Grant. And as our portfolio strategist, and I know right now is a busy time of the year for you. We're doing our kind of second round of a deep dive into the strategies and making sure we have them dialed in for the second half of the year. So it's always a great time to circle back to your advisor. I know summers can be hectic, but if you find the time, it's a good time to just kind of take a check-in and see where you're at. And before we know it, we'll be talking about post-election and year-end and 2025. So don't blink, I guess. All right. Well, thanks for joining us again. We look forward to seeing you back next month.